never chase past returns. That is one of the worst way to invest. Because the past high returns don't belong to us, they belong to someone who invested in the past. What price you pay for any asset class, whether that asset class is bonds or equities or funds, if you overpay, the return tend to come down. When valuations are expensive, invest in hybrid funds or multi-asset funds, and when valuations are cheap, invest in equity funds, and within that, maybe aggressive funds like small and mid cap. Mid and small cap generally have higher percentage of volatility, but mid and small caps also have great companies, which over time deliver superior compounding. So it is a good space to be in via good funds, not directly by buying stocks, because if you don't have the skill of choosing the right stocks, you can actually meet with a lot of accidents.
Who better to learn how to manage your own money than from the masters themselves? For this reason, we are starting with a very special video series called Guru Portfolio, wherein we'll be talking with key leaders in the financial services industry and discuss how they manage their own portfolios. For this very first episode, we are joined by Kalpen Parekh, MD and CEO of DSP Mutual Fund. Hi, Kalpen. Welcome to the very first episode of Guru Portfolio. It's really great to have you here. Kalpen, coming straight to the point, how has last year been for you in terms of your asset allocation, and what has changed?
Firstly, thanks to you and the team at Mint to invite me and for doing this series. This series I personally like a lot because I feel, like what Nassim Taleb has said. He always says that don't give me your views, show me your portfolio. So it allows us to express our opinions and views in a very tangible manner. And I want to start with two disclaimers that my portfolio is not a perfect portfolio. I am not a guru. I am a student of investing for the last 25 years, and I continue to make mistakes and keep learning. So whatever I say is not to be seen as a perfect portfolio. This is a portfolio basis my stage of life, my understanding about investing, which keeps changing and evolving with time. And sometimes what is my belief system today could actually be a bit different than what it was a few years back. The second disclaimer I want to give is that I have been conservative all through last year. My portfolio's broad asset allocation has been 65 in equities and 35 in non-equities. Broadly, my view was that small and mid caps are becoming a bit frothy, but these two views have tended to be a bit too conservative, and the markets have remained, in a rising mode. So take everything that I say with a pinch of salt, and an acknowledgement that markets don't necessarily react to how I think. I'm saying or doing things in my portfolio as per my own judgment. So with that backdrop, the whole of last year, like I said, my asset allocation in many of the last few years, in fact, if you look back since the time you started doing this series, I think it's been 3 or 4 years, has generally been around 65-35, two-thirds in growth-oriented investments, which is largely equities, and one-third has typically been in protection-oriented instruments. Because in the last few years, including last year, generally I've felt that equity markets, whether in India or rest of the world, are pricing in most of the good news, and upfronting the returns, and hence in the coming 3 to 5 years, the protection bucket, its returns will not be too less compared to the growth bucket. In the very long term, the growth bucket, which is equities, typically tends to earn 2 times returns of the protection bucket. This is very broadly. But generally, when markets run up sharply in terms of valuations, equity assets return very similar to fixed income, maybe 1 or 2% gap. So that is the foundation of why I do what I do. And generally, when valuations are high, my tilt is towards hybrid funds. There are different nature of hybrid funds. There are 4 or 5 styles of hybrid funds which are available. I may choose one or two or any one of them. There is no science to it. But broadly, the thesis is when valuations are on the higher side of long-term history, my preference is for hybrid funds. And when valuations are fair or cheap, my preference is for pure equity funds. I want to dial up risk. In most of 2023, my idea was to moderate risk rather than dial up risk. And that is why incrementally my exposure, all the new money that I had in the last 12 months, broadly went into hybrid funds, selectively in equity funds, where these equity funds also had a choice to invest in global stocks, and these equity funds also had some amount of defense through hedging mechanisms. So um, I started the year at 65-35 exposure. I ended the year more or less at 65-35 because of mark to market, the 65-35 would have become around 75-25. But a lot of my incremental investments, I would have done at a 50-50 ratio, very crudely.
Between equity and
Between
non-equity.
equity and non-equity. And within equity also in the last 2-3 years, or mostly in the last 4-5 years, I have learned that, and it's a bit late learning, but the learning is that there are great businesses available in India and there are great businesses available in the rest of the world. And today mutual funds in a very transparent and cost and tax efficient manner allow us to invest in best global businesses as well. So why not take advantage of that? So that has been, so my preference in the last 12 months has been in hybrid funds which are investing in Indian equities and global equities together, because that allows me to increase my, reduce my home country bias in a way, and generally diversify my portfolio to a diverse nature of businesses.
Right. And how did your portfolio did last 12 months? What were the returns like?
So in absolute amounts, in absolute return terms, it did well. I think around 28-29% return. But in relative returns, if I just look at simple, let's say Nifty or Nifty 500, average return would have been around 35%.
Okay.
So a pure equity index would have delivered around 35% in the last 12 months. This portfolio with a 65-35 tilt delivered around 29% return.
And what worked for?
And I just want to add here that, see, this 29% is a 1 year return. There are years when a portfolio would have gone up by around 100%. There are years it will even go down by 15 or 20%. So annual returns are very lumpy, both sides. Broadly, long-term returns that I've seen across countries over the last 40-50 years, the long-term annual returns of equities tends to be 4-5% extra over inflation. So in the last 20-30 years, if average inflation in India has been 7-8%, equity returns have earned around 13-14% return. So just keep that as a backdrop. So 29 is a number in isolation which has no meaning. My long-term returns are definitely not 29. They will be somewhere in the range of 14-15%.
Right. No, we'll come to that, your investment philosophy and how you keep your expectations moderate. But what worked for you in the last year, which funds did well? And then obviously we'll get into that.
So I think one fund which I personally like a lot, not because it's worked in the last 1 year, but it is the design. I am a firm believer when I invest. I rarely look at what is the return in the last 1, 2, 3 years. I look at what is the approach of that fund, what is the design of that fund, and does that design enable me to not constantly keep track, not have the need to keep rebalancing. So this is a fund called Value Fund, where it was launched around 3.5 years back with a very unique differentiation that every equity fund in India, which is a Flexicap fund, has around 35% in banks or lenders, because that's the nature of our market. That's the size of the profit pool of lenders also. It's a very large profit pool. So every fund will have that exposure. So we had launched this fund with an intent to differentiate. So we said we will not have any banks in it. So straight away 30% gets free. And that 30% gets deployed in global funds or in global stocks. And the global component has companies like Berkshire. Berkshire is the largest weight. So I feel nice, I'm exaggerating a bit, but I feel nice that Warren Buffett is managing some part of that money for me. And there are 4 other managers like Lindsay Train, Harding Loevner, WCM, and Veritas. And these managers have invested in different parts of Europe and Japan, but in dominant companies which are dominant, having between 20 to 25% ROCE, companies which are growing steady between 7 to 12% growth rates, very high ROEs, very low leverage. So this component of 30% of global stocks compared to the banking component, basically it has a very low beta compared to Bank Nifty. So Bank Nifty has a beta of 1.4. This component has a beta of 0.4. So it basically gives me a slightly different profile of profit pools, which are generated without any leverage, because these companies don't need any leverage. So this is a unique portfolio which did well last year, incidentally not out of design or thought early, but because last year banks didn't do that well. So to that, and global stocks actually have started doing well. So this was a unique portfolio which with lesser volatility delivered around 38-39%, or better returns than Nifty 500, but with far lower volatility. This portfolio all through has been having around 12 to 15% in cash. So it cushions me on the downside. So if the market had an alternate history, which is it would have been more volatile or trending downwards, maybe this portfolio would have done still better than the rest of the market because it was conservative. The other part, two parts of the portfolio did very well were the more aggressive versions of my portfolio. We have been known to launch funds generally in low cycles. We also do a lot of thematic funds for discerning investors or sophisticated investors who want to get exposed to a theme. So around 4 years back, just pre-COVID, we had launched our healthcare fund. So that is, I think, a 4 or 5% part of my portfolio. So that did well in the last 1 year. Then we have a fund called Natural Resources and New Energy. So this portfolio invests in metals and mining companies of India. It invests in energy companies of India and energy companies of the world as well. 30% goes to global energy companies, renewable companies, and renewable energy companies and stuff like that. That portfolio ended up doing better in the last 1 year. So that again is a 4 or 5% part of the portfolio of my equity component, not the entire component. So and the small cap bucket. So some part of my direct small cap fund. I think small cap fund would have delivered around 45 or 50% in the last 1 year. So these three components did well, apart from the value fund.
Right.
But you should also ask what didn't do well, and because if all did well, yet my overall returns are slightly less than benchmark, which means something didn't do well.
Right, right.
And what didn't do well was, I think, the around 5% of my overall portfolio is in our gold mining fund. So as a proxy to gold, I invest in gold through sovereign gold bonds and this gold mining fund.
Which invests in equities of gold mining
It
companies.
invests in stocks of mining companies
Right.
which mine gold, and it is a very volatile portfolio. I normally don't recommend it to our investors because it has very high fluctuations. So it has almost a 2 beta to gold prices. So when gold prices rise, it rises 2x. It falls by 2x. So that I think delivered flat returns, no returns at all in the last 1 year. So that pulled down the returns of the portfolio. And of course, the balance 25% of the portfolio, which is only in fixed income, while compared to fixed income alternatives, it earned 8 to 10% return, which are reasonably good returns as a fixed income play. But compared to the equity segment, it earned slightly less.
And how are you looking at debt right now? Are you repositioning yourself on that
So,
space?
like I said, I have a bias for inaction. I don't like to act. I want to spend all my time, focusing on increasing my earnings by focusing on my job and doing better, for my company, or have free time for myself and not spend too much of time on my investment portfolio. And which is why I like to choose funds where they will automate or on its own they will navigate. So exactly a year back in February, I had invested in our strategic bond fund, which is an actively managed bond fund. So that increases its duration whenever it believes that interest rates may, come down in the next cycle, and it brings down its duration whenever it believes that, the rate cycle is played out. So all through the last 24 months, it was running duration of 1 to 2 years, which was, short, like a short-term fund. But sometime in Feb and March, it picked up duration, and even as we speak, it has a duration of around 9 to 10 years. So, so it very aggressively adjusts the portfolio on the yield curve depending on what the view of the fund manager is. So that takes care of my active management. Some of my older fixed income since 2010, 11, 12, 13 have been again in an actively managed bond fund. Those investments are not in DSP, but they are in my earlier organization. And even that fund manager very competently has navigated. So the whole of last year, most of these debt funds that I have had a higher duration exposure, which has, at least as of today, worked for me, because generally interest rates have tended to be lower. Bond yields have come down by 30, 40 basis points over the last 12 months. So incrementally, I'm not doing anything. The fund is automatically adjusting its duration.
Right. And all your mutual fund investments are through DSP schemes, if I'm correct.
Since 2017, when I joined DSP, all my incremental cash flows are invested only in DSP funds.
Right. And Kalpen, how would you define your investment philosophy as? What kind of investor you see yourself as?
See, I keep on evolving. I didn't have any philosophy for the first 10, 12 years as an investor. It was very random. It was looking at past returns and investing. And it was basically reacting to whatever data is available, not necessarily that whether that available data is the right way to look at it. So the easiest available data for us is returns, because we publish returns every day. So I have been a victim of constantly adjusting portfolios to past returns, and over time, as you mature, you realize that this is a very bad way of investing.
Now at age 51.
Yeah, at age
Right.
51. So why am I highlighting this point is that in spite of being in this asset management industry, the first 8-10 years were doing investing the wrong way. And through your medium, I would like to, tell viewers also that never chase past returns. That is one of the worst way to invest, because the past high returns don't belong to us. They belong to someone who invested in the past. And by the time you are investing, you are actually coming in when large chunk of the return may be behind you. My approach to investing is, now I've realized, and as some bit of corpus has also built up, is I want to earn, I want to stay invested for the long term is my first goal. Hopefully for 4, 5, 6 decades if I live that longer, or maybe for the money will move on to the next generation in the family. But I don't have significant expenses. I'm a net saver every month, and hence a net investor every month. So my time horizons have to be long by default, number one, because in the equation of compounding and wealth creation, the variable which has the highest impact is the variable time, because it is raised to the power of. The variable which has moderate impact is return, because it has plus sign before it, if you go back to the formula of compounding. And the variable which has the second highest impact is P, because next to P is multiplication. So how much can I save every month has the highest. So the two variables which have the highest impact are P and T. So I'm a net saver, so P I take care of, but I now want to ensure that my T is very long. What reduces T for most investors, including me, is intermittent fluctuations and volatility. When vols are very high, we tend to panic and get out. So my bias is for such investments where returns may be moderate, not very low, not very high, but the volatility also is not very high, and hence, as an outcome of that corollary, my second belief is that what price you pay for any asset class, whether that asset class is bonds or equities or funds, if you overpay, the return tend to come down, because if you buy a good asset even at a very high bad price, the net return finally will not be very high. So my principle is, first of all, buy good companies or invest in such funds where quality is sorted. It doesn't, go down the quality curve. But at the second instance, the valuations also should be reasonable and not, recklessly expensive. So my choice of funds also, hence, are such funds where the quality and valuation component is well balanced. Uh, but there are times when markets don't care about our philosophy. They can take valuations to higher extremes as well. And hence, my investment philosophy over time that I've realized now is, when valuations are expensive, invest in hybrid funds or multi-asset funds. And when valuations are cheap, invest in equity funds. And within that, maybe aggressive funds like small and mid cap. So this I have narrowed down as my investment approach. And lastly, when interest rates are very high, generally when you invest in high interest rate regime, the future returns of a debt fund, which has longer duration, is very high. So when the rates are very high, increase percentage towards duration or calibrate exposure. So these are broadly my boundary conditions and decision making framework.
And for you as an investor, what kind of expectations you think are reasonable from equity over the longer term?
To be honest, what I expect doesn't matter, because markets don't care about what you and I expect. Let's say my expectation is 15%. Markets don't necessarily deliver 15. I expect 10, and so there are years it may give minus 20 or plus 100. So the another important learning that we need to have as investors is that our expectations don't matter. Markets deliver to us, one, what we deserve, depending on our behavior and time horizons, and what is realistically possible. And generally, realistically possible returns from equity as an asset class is over a very long period of time, whatever is the inflation, plus 4 to 6% is the return that you get from equity as an asset class. Very crudely, most often this is the outcome that you get. And if you buy that asset, so it means if inflation is, let's say, 6% in India, another 5% if you add, 11% can be your long-term return. But if you invest at very high exuberant valuations, then even that 11% can come down to 8 or 9. And just as an example, if you had invested in the peak of 2000 or the peak of 2008, even after the next 10 years, market returns were 8 or 9%, which were very close to what fixed income gave. So I don't invest basis my expectations. My starting point is where is the risk relatively lesser at this point in time. My portfolio should have more of that component. It doesn't matter then whether the last 1 year return of that component was high or low. So if I believe valuations are very high, let's say, and bond yields are very low, it means the risk is high in equities and bonds. And for the last 10 years, gold has given zero returns in dollar terms. I'm okay to tweak my exposure to gold and increase that because the perceived risk for me at least is much lesser right now. It may or may not give returns in the future, I don't know. Because when I'm investing, I don't know what is the likely future return. So my approach of investing is through a concept I call as inversion, which I've learned from some of the investing grades, that where is the perceived likely risk moderate or low, allocate more there. And where is the risk very high, under allocate there. Like at high valuations, risk is high in equities. But in the very long term, equity volatility is not risk. Equity is important for compounding. So have to be in equity. But because if valuations are very high, I calibrate it through my hybrid fund, which will have between 50 to 70% in equities.
And Kalpen, what is your advice for investors who are watching our show, especially in the current environment where there are concerns around mid cap, small cap valuations? How should they approach investing?
So one, I would say that invest not seasonally but multi-decadal, have long-term time horizons. Match the choice of asset class to the time horizon of your investing, independent of what our views are or what the market is saying. So if your time horizons are less than 3 years, don't care about equities, be in fixed income. Not even hybrid funds. If your time horizons are 5 years, be in a hybrid fund. And if your time horizons are 10 years, then be in equity funds. That's my first starting point. Second approach would be that typically mid and small cap generally have higher percentage of volatility, but mid and small caps also have great companies which over time deliver superior compounding. So it is a good space to be in via good funds, not directly by buying stocks, because if you don't have the skill of choosing the right stocks, you can actually meet with a lot of accidents. So in small and mid cap, my bias would be to invest through good fund managers and through SIPs in today's market because valuations have run up. So when you do SIPs, why am I saying SIPs? Is because let's say you start a 10-year SIP in a small cap fund, you will effectively do 120 transactions, right? 120 monthly purchases. So in today's month, you'll only invest one installment. So 1 divided by 120 is what you're investing. You're not putting your entire money. So today's valuations actually then become less relevant because you are going to invest over 120 months, and over the next 120 months, valuations will go down, they will come back, they'll go down. So you are taking away the risk of high valuation if you're doing SIPs. Another better way of investing in small and mid cap is through Flexicap funds or multi cap funds, where the funds will automatically navigate you. So like our Flexicap fund today has around almost 53% in large cap and 47% in small and mid cap. So in my case, even though we have some of the stellar track records in our mid and small cap funds since inception, but I participate in them through my Flexicap also, which is my core, because the Flexicap itself has half the portfolio in small and mid cap. So I don't have to necessarily worry. So let's say today, if I was only in small and mid cap, I may have to worry. Now, what do I do? But because I'm in Flexicap, my fund manager will manage, he'll navigate. And I think I would also, tell your viewers that it's very important to have a good advisor who can understand you and design your portfolio. So what I may say may be completely irrelevant to your portfolio because your needs are different, your time horizons are different, your appetite for risk could be very different than mine. So many times people listen to few of us and then start forming their own assumptions, but it may actually end up being harmful.
Right. Thanks a lot, Kalpen, for joining us today and sharing all those insights.
Thank you. Thanks.
Hope you got some insights from today's episode. We'll be back with another episode very soon, so stay tuned on Mint.